All right, we're not going to wait any longer. We're just going to go ahead and get started tonight, and we're going to be spending some time with maximizing your veterans loan and the information that goes with that. I'm going to go ahead and share screens here in a second, and we're going to go ahead and get going on the information. And so I know that we probably have a few people here that are going to be, as far as veterans. And so we want to make sure that we answer any questions that you might have for this along the way. And so let me see here where here's the share. And here we get going. So bam, here we are. All right, so welcome to tonight, and thank you so much for coming out tonight to share a little bit of time with me and go through the Veterans Workshop. And we're going to be covering quite a bit tonight when it comes to getting you set up for purchasing a home with the Veterans Administration. Tonight's agenda is really going to be right here. We're going to be go ahead and get our agenda right here, which is we're going to talk about overview and general information. We're going to talk about eligibility. We're going to talk about entitlement, and we're going to be talking about loan types as well. So as we're going through the process here, it'd be really cool if you do have questions, go ahead and get yourself set up so that we can answer any of these questions as you're going along. There are several different loan types that we're going to be using towards these. The veterans loan does have some great opportunities in there to help the veteran first time or multiple time use in order to be able to buy homes. We're going to talk about the funding fees. We're going to talk about some underwriting and qualifying information, some credit events. But even more than that, we're going to be diving into some of the strategies to help our veterans be able to purchase, whether it's their first home, second home, or many other ones as we go along in the process. So here we go with that, covering our agenda right there. So as far as how the Veterans Administration loans actually started off, they started post-World War II, and they were really designed to help veterans assimilate into civilian life. Prior to that, they really didn't even have this program. And it was actually a very interesting way for them to try to get veterans assimilated back into civilian life. It was designed after World War II, it was designed for veterans and then also for active duty personnel who would be involved in it. And believe it or not, 10% of our population in the United States is actually a veteran or active duty. So this is actually a really popular loan. It does have some idiosyncrasies, but we are going to work our way through this. And starting with it, we're going to just talk real briefly about the general information that the loan is going to be requiring when it comes to purchasing one of these homes through the Veterans Administration. Um, these are considered to be what are called full documentation loans. And so when we're talking about a full documentation loan, what that means to you is that we are going to be looking at credit, we're going to be looking at income, we're going to be looking at assets, and we have to prove the ability to repay. And so there are some pieces with it that we do have to go through. And in the credit documentation that we're going to be requiring is we do have to support it through pay stubs or other items like that. Now, if you're within an active duty, meaning that you're still on base or you're trying to buy a home off of base, then the LES is one of the pieces that we would use in lieu of pay stubs that you would typically get from a full-time employment once you've separated from the service. One of the great features of this loan is that there is no down payment requirement. And this is actually a fantastic deal for veterans, especially first-time veterans who are getting out of the service right away, is that many of them don't have a lot of cash saved up. And so there's no down payment requirement with this type of loan actually really helps the veteran get into this home very easily. And it's so flexible when it comes to this because many times with this type of loan, you can purchase actually not just a single family, but believe it or not, you can buy multifamily with this type of loan as well. And with that, what that means is that I've had buyers that are veterans buy duplexes, triplexes, and up to quads, meaning 4 units, with a VA loan and be able to move right in, live in one of the units, and collect rent from the other units that they have purchased with these homes. I mean, I can tell you that it's fantastic. It's because it really does help set up the veteran for success. And in the case of a multi-unit, it really works well because even though you have to buy these as primary homes, you can use that income from the other rentals in order to be able to offset these payments right here. And that's fantastic. Now, these VA loans are also assumable, and that's actually a big conversation in the marketplace right now because there are a lot of veterans who are looking to get out of their current residences and maybe they have to relocate to other parts of town or maybe to other states. And they have loans that are sitting there, and these loans have interest rates in the twos. I know I helped one gentleman do a refinance way back in the day, and his situation was so amazing because he got a 1.75% interest rate on one of his homes. Now, can you imagine assuming a loan with a 1.75% interest rate? That is just like crazy talk as far as being able to get into that home and be able to have an interest rate of 1.75. Your payment would be amazing with something like that. The only challenge with assumable loans, and this is if you're a veteran here on right now, or if you know a veteran who might be interested in assuming a loan, the assumption of the loan, let's just use some basic math so you can kind of get into it. Let's say that the homeowner, the veteran who owns a home at 500,000, but he currently only owes 250. And so in that case, there's a gap there of 250,000, which means that whoever's coming and wants to assume that loan would have to give him $250,000 in cash to be able to take over that loan at that interest rate. So it is possible, but I do have to say that there are some roadblocks with this. And from a veteran's perspective, an assumption on a loan isn't as attractive as it sounds. Because with the VA loan assumption, this is actually a really big deal, is if a veteran assumes another veteran's loan, that's great because the veteran doesn't lose his eligibility. It's not consumed by that house, and the new veteran takes over, even if it's a loan assumption. Now, having said that, if a non-veteran is coming in to assume that loan, pretty much in essence, that eligibility gets consumed by that non-veteran as they're moving into this house. And it really puts them in a situation, the veteran, to where they may have limited eligibility to go into the next property. And so that's a really big deal because that eligibility stays with that house until it's either paid off or it's sold. And you know how that works. Many times that can take a long time. And here's the problem with it too, is let's say that the owner that takes over on that assumption ends up getting foreclosed. Well, guess what? You lose that eligibility permanently. And so it's not always a wise idea for veterans to let others that are non-veterans assume the loans, but in the case of a veteran to veteran, in some cases, it can actually be a really good selling point if you're having a hard time selling a house. So those are some places when we come into the assumable piece of these loans. With the credit score on the VA loan, believe it or not, you don't need a credit score in order to be able to buy a home with a veteran's loan. Now, it certainly is better if you do have a credit score, but you don't have to have one. Now, don't mistake what I'm saying, because not having a credit score and having bad credit are two very different things. Because bad credit is certainly going to be a problem, but a no credit score, that just means you haven't used credit cards, you maybe have paid cash for everything you're buying and different things like that. The VA is not sensitive to credit scores. They just want to make sure that they're serving their veterans. Now, that doesn't mean we have to prove that you have the ability and the willingness to repay. That's going to be the key piece with the credit score, is that we really truly have to prove that you have that ability and willingness to repay. And that's going to be such a big deal that we're going to have to get and build kind of like a little bit of a credit history behind the scenes. And so that means that if you have car insurance, we were going to want to get and see that you've made your timely payments with that. If you have a cell phone, that you've made timely payments with that. We can also use gym memberships. We can use Netflix. We can use other things like that to establish what we call non-traditional credit. And those are opportunities for us to be able to help the veteran get in the door with a zero credit score. And sometimes that does happen where we have to go through that process. And it is a little bit extra work, but it doesn't necessarily mean that they can't buy. Now, one beautiful thing about this, and this is where we get into some of these higher priced areas, like in, Washington, D.C. or maybe Hawaii, where home prices are a little bit crazy and out of the box, the veterans loan doesn't have any maximum loan limits with the full eligibility, which what that means now, what that does mean is that your eligibility does run out after a certain point. So if you're buying a $2 million home, they're not going to 100% finance that $2 million home. They'll finance up to where your eligibility runs out. And so that kind of gives you an opportunity to understand that they're really vested in trying to make this work. And like I mentioned before, they are very vested in making sure that it works, even if you're trying to get multi-units, whether it's a 2 unit or 3 unit, up to 4 unit properties. So these are great ways to kind of help you get through this. Any questions? I'll keep going. I heard somebody unmute themselves. Oh, no questions? All right. Keeping going then right here. There are some ineligible transactions that they're going to be doing when it comes to veterans loans. For example, they're not going to let you buy this in an LLC. It's not a business related loan. They aren't going to allow you to get into a situation where you're sharing equity with other people. Yeah, it doesn't mean that you can't do the gift of equity upon a sale. That is a very popular way of buying a home, even with a VA loan, that can work. And the gift of equity, what that is if you're buying among family members and the family member wants to sell you the house, and let's say it's worth 300,000, but they're only going to make you pay 200 for it, then you can use that $100,000 towards closing costs and also equity in the house. And so that is something that you can do with a VA loan as well. Now, one really big button with them is they want to make sure that this is really designed for veterans. It is a true veteran benefit. And so one of the old school things that we run into periodically is we have a lot of non-married partners that are cohabitating together and they want to buy a home together. One's a veteran, one's a non-veteran. Where this gets to be a little bit of a challenge is that non-married co-borrowers, it doesn't mean that they can't buy the house with a VA loan. It's just that the Veterans Administration is not going to give you full eligibility. Now, what that means is that, in essence, what they're doing is they're guaranteeing, the Veterans Administration is guaranteeing 25% of the down payment. In other words, if you were to default on the loan, the bank would get reimbursed a certain part of the money, up to 25% equity on the house. Well, when you have a non-married co-borrower that's going to be jumping into this, they won't do 100% financing and they'll only guarantee half of that. So in other words, 12.5% of whatever that would be. So that means that you would have to come to the table, if you have non-married co-borrowers, you would have to come to the table with at least 12.5% for a down payment on this, plus your closing costs and other factors like that. So that's a little bit old school when it comes to that, but that's really designed because they want to protect the veterans from getting into situations that they can't get out of. Now, if you still have partners, but both of them are veterans, then they can both use the eligibility. It doesn't necessarily affect them a whole lot. Now, getting on to the eligibility, because that's actually a really good conversation for us, is veterans, the veteran eligibility that we can get into is for active duty who have served at least 180 days during peacetime or 90 days during wartime. And this is pretty good because as an active duty personnel, you can get in less than a year, you can be, as long as you have honorable service, you can in essence, be eligible to get a certificate of eligibility and buy a home through the Veterans Administration very quickly and easily with one of these programs. Now, it can be for reservists as well. And so we actually can see how reservists can actually, and National Guardsmen who can do it, but there is a time that's a little bit longer timeline for National Guard and reservists because they're going to be expecting you to have been in the National Guard or as a reservist for at least 6 years. Um, that's one of their core things. Now they have some separate documentation for reservists and National Guardsmen, but in essence, it doesn't disqualify them. It just changes how their eligibility works. This next one right here is actually really good too, is the spouses of servicemen who have or women who have died in the line of duty or have service-related disabilities and have died from those service-related disabilities. I can't talk right now. Service-related disabilities. They actually can use their spouses. So if they're widowed or a widower and their spouse died either through a service-related item or because of active duty, they actually can go ahead and they can go ahead and buy. And this is actually, it even works with the surviving spouses, even if they remarry. Now, this one that we have right here where it says who remain remarried on or after age 57, that has actually been changed. And that is, believe it or not, it's pretty much any surviving spouse, but they have to have died in the line of duty or in related situation like that. And then also you can do that for public health service officers of NOAA, midshipmen, the Naval Academy, and other things like that. So eligibility is actually pretty broad when it comes to services and also the veterans who might be reaching out to get this done. Now, what is entitlement? This is the real question because what happens is once you have you're eligible for it, you have to receive what is called entitlement. Now, when we're going to check your entitlement, we have to usually, if you've been separated from service, we're going to have to, get your DD 214, which is a statement of service. We're going to have to understand your eligibility. It is based on the length, kind of like we talked about before. And, I have had people who have come to me that have had dishonorable discharges, and they've been wanting to see if they could get into get it using their VA service. And unfortunately, when we pull the certificate of eligibility, it tells us right on there whether they're able to do it or not. And that certificate of eligibility is a document that we use that tells us how much of their entitlement is remaining. And it also tells us how much the lender is going to be guaranteed in case of a default. And so we usually grab that information from the veteran and we submit it to the VA. And within about 24 to 48 hours, they send us back the certificate to let us know what the eligibility is and how much can be used, or if it has been restricted. Because if you've used it already previously, you may have a reduction in how much you have left. And that's actually pretty important to know because until you restore that reduction, you're still going to be at that lower number until it's restored. Now, if you've sold the house or anything like that, you can go ahead and reuse it. But that's in fact what we're going to be talking about next is you can reuse the certificate of eligibility over and over again, but it is tied up until it is restored. And so you can reuse it, and there's 3 or 4 different ways that you can actually get it restored. You can either pay off the original loan, which means that you're going to sell it and you're going to sell the property to somebody. They're going to buy this property, and then what they're going to be doing is restoring. Once you pay it off, it restores your eligibility back so that you can use it all over again. Another one right there we talked about briefly earlier is if the loan is assumed by another veteran, they can actually get it restored as well. And then let's just say that you move, we have this actually happen quite a bit, where veterans move from one state to another state. Well, here's the great thing is if they used a very small bit of their eligibility in the previous state and they're coming here wanting to buy, many times we can reuse whatever's left over that eligibility and still help them get into another home. Now, there's a very special mathematical equation that we have to go through to see how much eligibility is left over. But in essence, that's really the most important thing is seeing what that is on the certificate of eligibility so we can calculate what it is. Now, the new home, there's 2 ways that you can get multiple homes with the VA. First one is that if your family size has changed and you've just outgrown the home and you're going to keep the previous home and you're going to turn the previous home or the departing residence into a rental, that is something that's fully capable of doing, or maybe you bought a duplex, triplex, quad. I mean, they convert that to a rental and then you're going to move into your primary residence. That is all legit. We can certainly do that and we can set you up that way. It does have to be the new home that you're buying, cannot be an investment. It can't be a second home. It has to be your primary home. And so this is going to be a really big piece with that. And with a secondary entitlement, what's so cool about it is that in many cases, if you didn't use a bunch of your entitlement on the first house, that what you'll have is sufficient entitlement to be able to get 100% financing on the second house. Or if not, you'll have a very small down payment that you'll have to put into the new house. And so it's actually a pretty cool system the way it's set up. And it's really a tremendous benefit because when you're buying this, and we're going to get into a little bit more, so I won't get too far ahead of myself. But in essence, you don't have any mortgage insurance when it comes to it. And so it really does help the veteran out significantly. Now, how do we have to prove this? We prove this right here with the getting your DD 214, or if you're in the National Guard, we get the NGB 22-23, and then we have to get a statement of service if you're active. Now, if you're buying, this is where we get into a little bit of a situation with this because, well, let me get into that next. Then what we're going to do is we're going to go to the e-benefits website for the Veterans Association Administration, sorry, and we're going to submit that information, and then it's going to spit it out, and then we can put in the benefits. We can also pull the benefits. You can pull them yourself. We can pull them ourselves. It is more accurate if you pull them. And then this is kind of what you see here is what comes out is we get the request for a certificate of eligibility, and then the certificate of eligibility actually spits out when we're done with that. Now, the great thing with this is that it really does help us very quickly understand what it is that we're dealing with, especially when it comes to a veteran. And if there are errors on this, we want to do this early on, because if there are errors, and sometimes there are, where the home has been sold, but the entitlement has not been restored. In which case, then, what we really want to do is we want to make sure that we help the veteran get this straight with the VA. And that can take a little bit of time in order to pull that off. Okay, now I'm going to take a real quick break and just kind of introduce myself to you as who I am and what I do. And my name is Chris Parks, and I'm a mortgage loan officer. And most people think that mortgages are a commodity. You get the rate, you get the loan, you push the button, and you move on. But I actually operate a little bit different. In fact, I built my business. I'm in the top 1% nationally by doing pretty much the opposite of that. Is in essence what I do is I try to focus on making sure that my clients get exactly what they need and that they're generally cared for. I believe in really giving, three client highs is what I refer to them as, is I believe in providing high clarity, which is high transparency, and making sure that you know what you're getting into. I believe in also giving high touch, which is making sure that my clients know exactly what's happening in the process and making sure that we're helping you get through each portion. Like I've just showed you some of the pieces that we have to work through in order to be able to get you your certificate of eligibility and get you where you want to go. We want to make sure that we're putting those things together in such a way that you have confidence, a high set of confidence with us that this is going to pull off. And then the last thing is we're going to be building through the high transparency and the high touch, we're going to be building the high trust. And that is where the most important thing is, because we're doing this on your behalf to make sure that you're getting exactly what you need to get and that we can create a predictable and referable experience for you so that you can, in essence, feel comfortable referring us to other people around us. I'll get into more of that later, but that's how we built the top one, our business into being top 1% nationally. And that's what we're planning on doing going forward, is we want to make sure that you and your family get everything you need in order to be able to get across this finish line. All right, now before I get into the next question here, or the next piece, are there any questions on what I've covered so far? You can go ahead and unmute yourself. Otherwise, I'll just keep plowing forward. All right, normally I play a little game with everybody in the next one. You don't really have to do this one if you don't want to, but this is a little game that I put in, and I'll just ask you, it's actually more of a joke than anything. So here's how, if you were a hot dog on an abandoned island, um, and you were starving, here's the real question: would you eat yourself? And I know I have a whole survey on this from a whole bunch of different people. You can certainly join in the survey if you want to. I know that's not why you're here, so I'm going to continue going on into the next piece of what we're going to be talking about next, which is the loan types. And so getting into the loan types, veterans loans are, very flexible. I've actually had veterans take loans in 5-year increments from 10 years all the way up to 30 years. The most popular one is certainly the 30-year. The 30-year tends to provide the most flexibility. But what I really like to point out when we're talking about this is that even though I'm helping you get into debt, one of the pieces that I'm very vested in is making sure that you build wealth in real estate. And so whether you get a 10-year, 15-year, 20-year, or 25 or 30-year, it doesn't really matter to me. I really want to make sure that I'm setting you up for long-term success and that I'm showing you how to save hundreds of thousands of dollars in interest by accelerating your payments and how to do it in a way that's not necessarily very painful. And I'm going to tell you that it's extremely important to take this because if you can make one extra payment a year, you will save yourself over $30,000 to $40,000 on a $400,000 home. And I'm sure you've got a better place than pure interest for that $40,000. And so this is a really big piece that is very near and dear to my heart. And I'll share with you why. Even though these are here, I can share with you a story about my family and my parents. You know, when I was growing up, we were actually very poor. We lived in a neighborhood. I didn't even have a bed until I was like 5. So I would say that we were in a very tough place. But I would tell you that my parents, what they did is they were smart in one area. Is what they did is they accelerated their payments and they paid off their house. And then what they did is they went out and bought another one. And they accelerated their payments on that one. And then they went out and bought another one. And now my father just passed not too long ago, but my mom is living in essence independently because they have the income from these properties. And so my goal is not, even though these are greater terms, these are big terms, 10 years, 15, 30 years, it feels like a long time. If I can show you how to pay the house off sooner, you're going to be able to create wealth through real estate and be able to live independently as well, just like my family has learned how to do. Now, with the loan types that are available, there are fixed rate, there are also adjustable rates. Now, adjustable rates get a bad rap. They're not necessarily all bad. For example, let's just say that you want to buy a home and you know that you're going to be in this area, let's say Fort Lee, for example, since most everybody on this call is here in Virginia, and that you're in Fort Lee. And Fort Lee, you know your timeline in Fort Lee is only going to be 3 years. And then after that, you're going to get reassigned to another part of the world. Well, guess what? If you got an adjustable rate that's a 7/1 arm, which is 7 years is fixed and it adjusts every year after that, but you get a much lower rate because it's an adjustable rate mortgage, as long as you sell or refinance once you leave, the adjustable rate doesn't necessarily mean it's a bad one. So there are pros and cons to each one of those, and it's really going to come down to strategy. And this is where a good conversation with a competent loan officer is going to help you get set up for these types of conversations. Now, with buy downs, you can certainly do buy downs, and that's where you buy the rate down. So, like right now, the interest rate for some good credit with Veterans Administration loan is hanging out below 6%. I think this morning it was close to 5.75. You could actually buy it down to 5.5 or 5%. Now, it would cost you some money to do it, and we would really want to look and see what that payback period looks like for you. Because not buying the rates down, what you're doing, that's a long-term play. It's a really long-term play. And there's nothing wrong with doing it, but you got to look at it as if you're doing a 30-year loan, it's a 30-year play. Do you want to buy the rate down? Are you planning on being in that house for a very long time? Sometimes it makes a lot of sense to do it, but in some cases, it doesn't make a whole lot of sense. Now, you can also do refinances. You can do cash out refinances. You can just do rate and term. Um, you can do now the Earl, the one with all the R's right down. That's a streamline. That's a streamline refinance where you can go from one VA loan to another VA loan. The costs are reduced. It's fantastic if you already live in it. And guess what? If you owned a home, let's just say that you own two, you have two loans with a VA loan. One is an investment home and one is now currently your primary. You can actually do both of those with the Earl. You can actually refinance both of them at the same time with the Earl and get streamlines on both of them. Now, there are funding fees, and these funding fees do apply to all of these loans. And it's going to depend on how much money you're putting down, as well as some other factors with it. And the reason why they have a funding fee is because well, right here, it says it's designed to cover the upfront cost by the Veterans Administration. It covers some losses, and most of the time it's financed into your loan, but you can pay for it in cash if you want to. Now, the reason why they do it is for two reasons. Is one, for the upfront fee is to cover the administrative costs, but number two is there's no mortgage insurance. Unlike a conventional loan or an FHA loan, you would have mortgage insurance on that loan for usually 15 years at least. Now, with these, there is none. And so that's actually a really cool thing because that can save you on a $400,000 home the no mortgage insurance can save you about $150 a month. That means that you could accelerate your payments with that 150, or maybe live a little bit more comfortably because you're not dealing with mortgage insurance, or maybe it gives you a little bit more buying power if you're in that case where you're being, put in a little bit of pressure with that. Now, every time you use the veterans loan, there's a slightly different cost for each one. And here's kind of like the graph as far as how it works. And you can see that if the top column's right there on the left, that's for the first time use, and then the second use is down below that. And you can see that the use on there for a first time with zero down is 2.3%. Whereas if you go to the second time down, and you can see that that's I think it's 3.6%. That's a fair amount of money. And so you have to look at this from the standpoint of what makes sense. Now, if you put money down, kind of like what you're seeing there, it actually gets lower than that, and it keeps going down. So 5% reduces it by quite a bit. And then if you're doing a second or third or 10% down or more, then you can actually see that it reduces it significantly there. Now, this is where we get into some of the details and of how it works if you have a service-related disability. Because if you have a service-related disability, as little as 10%, many times these funding fees get completely waived. Now, I know that sounds like, okay, well, 2.3%, that's not a whole lot of money. It may sound like that, but I'm going to bring a calculator over here, and if I can grab it and bring it over, and I'm going to show you a little bit about that 2.3%, because let's talk about a $400,000 home, and we have 2.3%, okay? That's $9,200. That's a fair amount of money, believe it or not. That gets added to your loan. That right there on a monthly payment increases your payment by about $60 a month. That's a pretty big deal. Now, if you get this waived because you have a service-related disability, then this is a fantastic gig for you because you're saving yourself $60 a month. Plus, now $60 a month, think about it this way, that's $60 a month times 30 years, that's 21,000 overall. That's a fair amount of money when it's all said and done, compounded with interest. So if you do have the ability to go and get into the VA and have them hook you up with information and get you rated as far as your service-related disabilities, this can actually make a huge difference for you as far as not having to pay this. Now, some states, I know that most of the states that I'm licensed in, which are Virginia, Maryland, Tennessee, Florida, and Indiana, those states that I'm in, they do have a provision to where, in essence, if you have a 100% disability through the VA, and the VA classifies it that way as 100% disability, they will waive your county taxes. That's actually a really big deal too. So that's a tremendous benefit for you to be able to go out to the VA hospital and make sure that you go through and get rated so that you know what your service-related disabilities are when it comes to your entitlement. And it will state that right on the certificate of eligibility. Once you've done all of that work with the VA and you get rated with your disabilities, it'll state it right on the certificate of eligibility, how much of it is, what percentage you have, and if you're getting a disability check, it'll tell us all that information right on your certificate of eligibility. And it'll actually help us understand how to best serve you and get you help as far as reducing your cost. Fantastic benefit. All right, going to the next one. One of the pieces that we have to do in this process is that we do have to, now we're getting into some loan details with this, is we do have to go through an automated underwriting system. So what we're going to do is we're going to gather all the data from the different veterans. We're going to put it together in our loan processing system. And then what we're going to do is we're going to go and put it in there and run it through the automated underwriting through either desktop underwriter, which is for Fannie Mae, or we're going to run it through Loan Prospector, which is for Freddie Mac. And both of these right here are going to spit out some readings for us, and they're going to tell us what we have to do when it comes to helping you get the loan done with this. It's going to give us underwriting guidelines. It's going to go through the data points. It's going to synthesize it. And then it's going to tell us what we have to do in order to get your loan across the threshold and help you move into the house. Now, that's one version of getting the loan done. Now, if you're a consumer or you're a veteran and you're on this call right now, that's probably like, whoa, what happened here? But that is truly what we have to do when it comes to mortgages. We have to run it through the automated underwriting system. Now, if it doesn't qualify for that, for example, let's say you have a zero credit score, then it doesn't mean that we can't help you get this loan. It just means that in essence, we have to manually underwrite the loan. Now, that's what I was talking about when I was saying that we have to get some alternative credit and it has slightly stricter guidelines. Okay. But it doesn't mean it can't be done. It just means that there are some stricter guidelines that the VA makes us go through because they want to make sure that they're not setting you up for failure. They really want to make sure that they're setting you up for success and that in essence, you're able to move into this home and comfortably live there and not get stressed out with your payments and make sure that you can stay there long term. Now, the next one, what you see there is overlays. Some banks or some lending institutions have additional guidelines above and beyond what is on the Veterans Administration website as far as the guidelines that they're going to enforce. Now, the reason behind that is that some lending institutions just want a better quality client. They don't want somebody who has a no credit score, or maybe they don't want somebody who has a low credit score. They just want to make sure that they're getting more higher, what they consider to be higher quality or A grade clients that are coming in. Okay, so now if we do have a couple realtors on here, I'm just going to do a little bit of realtor talk real quick for you realtors. If you are a realtor on this call and you are sitting here kind of figuring out, hey, well, what does that really mean to me? What that really means to you is if you're getting a pre-approval from a lender and they haven't done these things, you don't have a pre-approval. You just don't have a pre-approval. And if you're a consumer on here and your lender has not done these things, you don't have a pre-approval. And so you really need to go through this. And what that means long term is you really don't even have a loan. You're not going to be getting a house because these are pretty much the things that everybody has to go to. Doesn't matter if you're a bank, doesn't matter if you're a broker, doesn't matter if you're a correspondent, all of these have to be done. We have to go through the automated underwriting or we have to do manual underwriting in order to get this done. And so this is really important if you are working with a buyer, you want to make sure that the loan officer has run it through the AUS, which is the automated underwriting system, and that you have an approval through that system. And if not, if they can't make it through that system, that they have actually gone through the status of manually underwriting this loan. And this is really important because many times we try to, especially with the ones where they don't have any credit scores or there are other factors that are affecting it, we want to make sure that we're underwriting it ahead of time so that there's no questions later. Nobody's wasting money. The veteran can waste money on appraisals, on home inspections. That's, $1,000 they can be out very easily, and then only to find out that they can't even buy the house. And so we want to remove all that doubt before we get them into a house or get them falling in love with something. And this is a very important process that we push. Before I move to the next one, any questions? Any questions before I move to the next one? All right. 5, 4, 3, 2, 1. All right. All right, so qualifying information. So here's some information that we work with when it comes to veterans, and this is actually pretty cool. Interested party contributions. Now, as a veteran, you can actually negotiate with a seller to have them help you cover your closing costs. And I've actually dealt with this before to where we've negotiated with sellers and sellers have actually contributed money to actually help the veteran get into a house. Now you can ask for up to 4%. Now that's a pretty big number. So let's go use the $400,000 number again right here. And if we do 4%, that's 5%, but here's 4%. That means you can get $16,000 from the seller, up to $16,000 from the seller to help you get into this house. Now that's a pretty big thing because if you can get 16,000, you really only need about 10 on a $400,000 house. That means you have $6,000 left over. That means you can use that money to pay off student loans. You can use it to buy down the interest rates. You can use it to, I've had people actually get the concessions that amount because they needed to pay a car off in order to be able to qualify to be able to buy the house. We helped them pay the car off and we actually helped them get into a house because they were able to get some help from the seller in order to do it. Now, not every seller is going to do this. I don't want to make this as a promise that it's going to happen like that because we're still in a market that's moving pretty quickly. In some parts of town, they're just not willing to give you anything. Now, if the house has been sitting for a while, it's a very good likelihood that you might be able to have that. Okay. Now, with cash reserves, which is the next one, is it's not necessarily required that you have any cash, but we do have to prove that you're not going to be destitute after closing. We want to make sure that you have the ability to eat, that you have the ability to go to work, that you have the ability to take care of yourself. And so these are parts and pieces that we are going to be looking at. You don't necessarily have to have a lot of cash, but it would be a good idea to have some. Now, the gifts. Now, if you have a family member who is totally vested in helping you with the purchase of this home, like kind of like what I did with my kids, is I gave them a little bit of money and I helped them get into their first home. These are items that you can do, and you can get gifts as long as we can prove where the money came from. And so here's what that means is that if you're going to get a gift from grandpa and grandma, which is actually very common, or you're going to get a gift from mom and dad, or maybe a gift from your brother to help you get into a house, all that can be done. We just have to get a transaction from the donor, transaction history from their bank account showing that they actually had the money in their account. In other words, that they're not wink, wink, you know, laundering money to give it to you. And so that's just one of the pieces that's part of it. But as long as we can prove where that money came from, you can get anything you need as far as a gift from that. And we actually find that family is very accommodating many times to be able to help you out with that. With more qualifying information here with income is you can use some in some cases some borrowed funds that you can't use a signature loan or a an installment loan or a personal loan in order to be able to get funds you need to buy a house, but you can get loans against secured assets. So if you have a Mona Lisa in your backyard or on your wall, Mona Lisa on your wall, or you have a Picasso on your wall, you can use art. You can actually get a lien on your art or something like that, and then they can actually help you with that. Or you can go to if you have collectibles, you have an original, I don't know, pyramid in your backyard, and you want to sell that, then you can do that as well. We can use collectibles. There's other real estate. We have a lot of people that get home equity lines from a home that they might own somewhere else and use that for the funds to close. Or you can get liens against your car. There are title loans for that. Or a lot of people actually use 401ks. They'll take either a loan from a 401k or they'll take a distribution from a 401k. Any of these things, as long as they're secured, these are ways for you that you can actually take money and be able to use them towards the purchase of this home. And so these are fantastic ways to help you get set up and get that little bit of extra cash that you need. Um, a couple other things that you can do and can't do is you can't have a cosigner that is not going to occupy the home. It's just on a VA loan, they're not going to let you do that. But as far as acceptable people that can is your spouse or other veterans. And then, of course, we talked about that. If you have occupying a co-borrowing occupant that is not a veteran, then of course that gets reduced a little bit there as well. Coming into a couple other ones that can happen. So the seller concessions can pay for all sorts of things. We talked about this a little bit. You can get up to 4%. They can cover the funding fee, the property taxes, gifts, points, all that stuff right there. We talked about that in brief. Now, talking about credit events. Now, we do run into this periodically with some of our veterans who have had a hard time for whatever reason. Maybe they've lost a home. Maybe they've had to do a short sale or a bankruptcy, Chapter 13 or Chapter 7. There are waiting periods. So the VA is actually much more flexible than most when it comes to this, but they still have a waiting period because they want to make sure that you're recovered. So in other words, you can't just go from losing a home to foreclosure and then go right into the next one. They want to make sure that you had a period of recovery and that you've shown signs of recovery, because what they're not going to do is they're not going to lend you money for another house if you can't prove that you have the ability to go back there without going back into foreclosure again, or maybe going back into bankruptcy again. They just want to make sure that you can get out of it. And so the waiting periods are actually, there for your protection more than anything, but it's also to help you recover. Now, I have to tell you that these are much more flexible than with FHA or conventional. 2 years from discharge date on Chapter 7 bankruptcy. That's pretty amazing because it's quite a bit more than that with FHA. And with the Chapter 13, the same thing. So these are all pretty good and very flexible when it comes to this. Now, once we've gotten under contract on the house, we do have to go through the basics of buying the house. And so they are going to require that we evaluate the home for value and condition to make sure that you're in a pretty good place and that you're not buying a home that is going to, in essence, put you in a bad spot. So they are going to require that you have an appraisal. Now, some of the things with the appraisal is that you can't get things thrown in like a lawnmower or a goat. I don't know if you want a goat or not, but I just had to throw that out there. But they want to make sure that you're not getting personal property that's really not attached to the land. If the shed is attached to the land, that's no big deal. That's part of the land. But they just want to make sure that if you're buying a Sears riding lawnmower, I mean, Sears isn't around anymore, but you get what I'm saying is they want to make sure that that's not included in the value. And so if you are doing a little bit of horse trading and you're going to get their mower, let's just put it on a separate addendum so we don't have to deal with it, especially when it comes to the appraisal. Now, this value of notification of value will follow the property for a period of time. And so, if you're going to be trying to buy this house, just kind of keep that in mind. Or if you're refinancing, just keep in mind that that does follow the property as well. And really what we're looking for when they do the appraisal, it's not just for value. They're going to be doing what is called a health and safety inspection on the property at the same time. And that's really just to make sure that that the house isn't completely falling apart. Now, they're not inspectors. So they're not looking to see if the outlets are all working. They're not looking to see if, they're going to be doing what's called a head and shoulders inspection. Now, with the head and shoulders inspection, what that means is they got to pop their head and shoulders into every room, and they got to look in every room to make sure that there's no, oh my God, what happened there in that room. And that's really what it's designed to do, is to make sure that they're looking into these spaces and understanding that the house is at least in a livable condition and it's safe enough for you to move in right away. That doesn't mean that you can't do cosmetic work. Say, for example, you need to repaint, or maybe you have to change some light fixtures, or the toilets are avocado green. Okay, I get there's some stuff like that that you're probably going to have to move and that you're going to have to change around. But that's stuff that's cosmetic. It's not necessarily something that's going to cause the thing to fall apart. But if there's a big hole in the floor, yeah, that's going to be a problem because they want to make sure that it's in good shape. So if they don't meet these conditions, the appraiser is actually going to notate that, and they're going to ask that they be corrected prior to closing. Now, that can be a little bit of a challenge when you're trying to negotiate with a seller, but just keep in mind that if you do run into that, what they're really trying to do is protect the veteran from getting into a place that they can't get out of. And so these are actually pretty important things. Now, one more thing with the properties themselves is the VA is not terribly fond of condos. Now, I know in some markets, for example, my Florida market, um, that's a pretty popular thing. A Florida condo is pretty cool, especially the ones overlooking the beach. But the condo projects really have they take a second set of eyes. So let me explain to you why, so that you kind of know what they're doing when it comes to condos. When it comes to condos, if you remember, probably 3, 4 years back now, there was a condo in Miami that just all of a sudden just collapsed. Well, it ends up that that reason that that one collapsed is because of lack of maintenance. They didn't paint the exterior of the building, and it was up against the salt air, and a lot of the rebar had actually corroded to the point to where it was no longer had any structural integrity. And what ended up happening is that, after surviving so many hurricanes, a slight breeze actually pushed it, and the whole thing came down. And really, what it came down to is they had not painted the exterior of the building for a long time. And the HOA, in other words, all the owners of the building, so let's say there's 200 units in that building, and you own a property in that building, you're 1/200th of an owner of the entire facility. Well, it wasn't just one person that lost their house, it was all 200 in this case that lost their house. And so you can kind of see that there's more risk when it comes to condos because it's not just about you maintaining your property, it's about the 199 that have or have not. And so if the homeowners association is behind in collecting their association dues, they're going to be a little bit more skeptical when it comes to the property itself. And so you can see there's a website that I've included there where there's a list of approved condos that the VA has already gone through. They said that these are approved and you can move forward. Now, that doesn't mean that you can't get a one-off approval on a condo that you absolutely love. But I am going to tell you that it does take more time and it is significantly more expensive to do it that way. All right, before I move any further, any additional questions? Any questions that maybe something I haven't addressed? Any questions? Going once, going twice. All right. Now there are quite a few resources that are available to you, and you can actually visit them on my website. And so on my website, if you go to the resources tab, you will actually see on my website a bunch of different items that you can download. It's all free, so feel free to just go there. You do have to enter your information because we want to make sure we know who's there. But for the most part, it's all free. There's nothing we're charging for this information. It'll give you tools on being a first-time home buyer. Maybe you want to be an investor. Maybe you want to build a new house. Maybe you need it in Spanish. All of that stuff is on my website, and you can download all of that stuff right there, and it's all entirely free. Even more than that, I do have a YouTube channel that I put this information on regularly. In fact, the month of November I have designated as Veterans Month. And so this exact recording, this is where it's going to be going. It's going to be going to my YouTube channel. But I also have a lot of different shorts on there that are related to different topics related to buying a home. In this case, in the month of November, it's about veterans. So you'll see a lot of information on the YouTube channel that is designed specifically towards the Veterans Association administration and the Veterans Loan. So would hope to have you come visit that and yeah, be a part of the conversation. You can, a lot of people give me all sorts of grief on there and want to argue with me too. So you can come argue with me if you want, or just be part of the conversation as well. Now, why do I do what I do? Well, I'll tell you what. A lot of my counterparts, they spend all of their time cold calling, buying leads, paying for partnerships, and I function very differently. Like I told you, I believe in high transparency, high touch, and high trust. And what I'm trying to do with my business is work 100% by referral. And the reason why I want to is because I want to devote myself to your needs before the transaction, during the transaction, and after the transaction. I've already shared with you a couple pieces of what I do and why I do it. It's because I really truly believe that home ownership is a very special thing and you can actually build wealth through doing this. And so this is an example of what I want to do is I have a simple strategy. I want to earn your trust. I want to do it very transparently. I want to do it through serving you at a very high level because I'm hoping that long term you'll actually refer me business once you're done experiencing it with me. So that's kind of how I work. I am really pretty much out of everything else. And look at that. I am 5 minutes early. I told you 7 o'clock. Here we are at 5 minutes early. Are there any questions before I let everybody get back to their evenings? Any questions that I can possibly answer?
I do have a question. Usually, I hear that they say that VA loans, it takes longer to get processed. If I have a ratified contract, how long it takes for to having a fully approved loan on a VA program?
That's a great question. I do have to tell you that there are a lot of people that do take their time with veterans loans. I have a fantastic team that actually does an amazing job, and especially if you get the loan pre-underwritten, which is what we suggest all the veterans to do, you really can close this loan as quickly. The slowest part of the process when it comes to a VA loan is the appraiser. The appraiser takes 14 days, and we cannot push them to do the appraisal. So typically what I'm telling veterans is that we can close your property in 14 days as long as the title company and as long as the appraiser can keep up. And that's pretty important because that is not the perception of the market. And I'm going to tell you that veterans loans are looked down on a little bit in the market because a lot of the lenders out there do take a long time to get things done. And 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 the seller many times just wants to get out of the house. So that's a fantastic question. 21 days is typically what we can do. We can do it without pre-underwriting it, but I would highly encourage you to pre-underwrite just because things go a whole lot smoother and there are less variables when we do it that way. Does that
I
help?
also have yes, thank you. I also have another question. I hear that your company has this CHB, well, the Home Buyer Certified Program. Can you do the Certified Home Buyer Program also for a BA loan?
We certainly can, yeah. Now, what a certified home buyer is, or the CHB, like you referred to, is what we actually do is we pre-underwrite the loan so that when you come out on the other side, you in essence are like a cash equivalent offer. And that's actually pretty important, especially if you're competing in some of the hotter price ranges right now, because you are going to be competing against cash. If you're a first-time home buyer competing in that lower area, you're competing against investors who want to buy these homes, and many times they have a lot of cash. If you're competing in that mid-range prices, we've seen a lot of people get help from family, and those people are also coming in with cash. And so coming in with a certified home buyer, getting pre-underwritten is fantastic because in essence, what we can do with that is when we're done, we're going to give you the cash equivalent offer. And even better than that, we're going to give you a guarantee. And this guarantee is a document that we actually provide your agent so that you can go and present it to the seller. And it includes a $10,000 seller guarantee. And now, what that means is that if the loan were to fall apart because of anything that we've done, in other words, we missed something, we're going to give the seller $10,000 for their trouble. Now, I have yet to do that. I have yet to give a check of $10,000 to any seller. But it really is a perceptual advantage when you're actually making an offer because not only have you pre-underwritten the loan, but you're giving a guarantee to the seller that you're going to close and you're going to close on time. And that's a huge piece. Even though it might be perceptual, it is a huge competitive advantage that you can put in front of a seller in a multiple offer situation that can actually help you pull this off. Now, I do need to let you know that it is, you still have to make a good offer. You can't make an offer that's significantly less than that, but it is something that that you can use. And I see, Veronica, you have a question in the chat. What was that?
Yes, thought I heard you say that people who are in the reserves need to have 6 years to qualify for the VA benefit.
That's correct. If they're in the reserves
Right.
or National Guard, they need to have 6 years of service
It's-
in
right.
order to do that. Now, if they go into active duty, then that changes everything. But if they're just doing the weekend warrior kind of thing, or the weekends, or the stuff
Yeah.
like that, the National Guard or the reserves, it is 6 years.
Okay, thank you.
Okay.
Okay.
Any other questions?
I don't think it was great.
Okay. Well, thank you so much for coming this evening, and happy Thanksgiving if I don't see you before.
Same to
Yeah.
you. Happy Thanksgiving.
All right. Happy Thanksgiving. Thanks for coming, everybody.
Bye bye.
Bye bye.